last time, and just showing exactly how you could find this. As a matter of fact, let's go to the Apple chart first. Like, let's screw ES real quick because I want to show you guys how it works on regular commons as well, right? So, we're gonna find intraday value instead, so we could like work backwards, all right? And I think that'll be the best way for you to understand it when you're looking at the big picture because even if I show it to you big picture, you're gonna get in the intraday and be like, what the like what am I supposed to be doing? Right? So let's come here and let's go on 30 minute. Why not? And the market opens at 9:30 here. And here you got a markup and et cetera, right? You got a little discounted price here. You see big sell volume here, right? Okay, so the first things you need to be able to do, like with your eyes, is identify the highest volume areas, the highest reactive areas. Sometimes the highest reactive areas aren't the highest volume areas because the shares being traded in that time are only one-sided. A lot of the times they're not just, big sells. Sometimes they're just like a bunch of buyers selling. There's not like, a bunch of shorts on it, or vice versa. There's not a bunch of buyers buying. There's just a bunch of shorts covering. So sometimes you'll see big candles like this and they'll have no volume. So keep an eye out on that. And a lot of times when you see that, like they kind of don't always get filled to the up or downside as fast as they would if they have volume because you know that there's unfair shares that hadn't been filled. All right. So when we're looking at this in the manner of like say let's say 30 minutes, you can look at it and kind of, try to identify. Oh, let me take this off because sorry.
Mullins.
Oh,
It's all good.
all right. My bad.
I don't even look at it.
On the 30 minute, you can kind of like look at the overall picture and, just kind of like do a little eye test before this opened in the morning. So let's just say we had this. This was our info, right? Let's say this is all the info that we had. Well, on a 30-minute time frame, we knew that there was a big level of sell pressure here. As you can see, it's in the same level as your volume, right? See how it reacts to that area. You have a big green candle here, right? And those obviously get filled the same way to the downside, right? And then on the top of that, there's another fair value fill here. See that? How that closely aligns all the way through, right? So what you want to do is use these candles as just like a little story that you have. Inverted hammers and being able to find where liquidity traps are is very important. For instance, here, right? This is a 30-minute, so likely you can't see what's actually happening on this inverted hammer when it happens. If you were to probably zoom in on the one, you'd probably see that this was a huge volume spike, and then you got a one close, two close, and you're risking the low of this candle on a close. When you see that and it's coming down generally, you can identify a liquidity trap. You'll see it come back down, try to hold the top of it, and then run, right? That's how we found other trades like Rev B and all this other shit. So what you want to look for is high reactive areas, right? So on the 30-minute, you have this, 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 right? You have this. All those candles matter, right? And the amount of shares that are traded within these time frames also matter, right? The smaller that the reaction is, the longer the move's going to take. For example, you see this tick 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 tick. That took really long. But on a crack like this, over this level, as you can see, the movement's much bigger, and it took less time than this. This averaged 60 cents, and this was over $1. See, very different. So you want to be able to find value and trade within those areas where you know you'll likely get the biggest move in the shortest period of time. All right. So firstly, we have as I said, we're gonna identify all these areas, just go in and tap them in, and then continue moving. I like doing the short ones first because I have a short eye. Mainly, I like to be long, but I can see the shorts first, so I like tap 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 tap. This is how I would personally do my chart, only because I don't like a dirty chart too much. But this is the levels that I'd put on my chart. Okay, these are the levels. This one's not going to matter to me too much because I can see where the low is. I don't have to draw an extra one. But sometimes you want to have that fair value median range for that sell or that buy. So you want to have this as well for reference. And generally, I'll leave that one as the dotted line because you may see some type of bounce or rejection on that fair value fill. All right. So now that we have established this over the past week, Wednesday to Wednesday, we know what the given range is, and we know where an excess high or an excess low would be if it were to trade correctly. For instance, this is one day into this day. From here, from this level, intraday, remember these are 30-minute periods. From here to here, if you think about it, this was actually the high of this level. This was the median, right? And this was the low. So if this was the median and it held the median here, this is now a high and it needs to find a new value low or a new base value. So you don't want to short it until it starts to show weakness and shows you that it wants to hold a level, a la this consolidation, right? So this will give you a slight determination as to where the new base value low would be. On a price increase or an exceeding of price, for example, like this. See this big this is what I call an exceeding of price, or I guess you can say an expanded price. A new base value is supposed to be had. So if it just runs up like this all the way, like you see like 5 candles like this, for example, if this is a new base value and it just runs up like that, it has to come up and basically you would want it to hold this level, right? See that reference? And if it does the same thing here and it cracks up really fast, you want it to hold the next level. So as it does here, cracks, it comes right back down to this one. And if it were to crack up here, you would want the low to be here. And if it were to crack all the way up like that, you'd want it to be here. All right. So all these levels change and they do the same in reverse. So, um, oh, next thing. So this is the new base value for that push, right? So that would mean that this is the low, that high is the temp high, and then the high is an excess high. Why? Because this was the low and it needed to find a high, right? The high was obviously a reference of this previous reaction sell candle. So that's your high reference before any of this happens, right? So that's why this level here is important because once this is encapsulated, it can now be held as a new base value low. Once a high, now a low. Once a low, now a high. You know, just kind of like in reverse. So as we crack and hold this level, boom, this is our new low. So now I can identify this as my end line temporarily, right? So this is my temp low. As you can see, it's darker than this one, right? So as the price progresses, and as I said, you get some exceeding price level, or you see, then you want to move your lows up higher and move your 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 targets lower and they reverse, right? So as we get over here, cracks excess high from the high, right? High, base value, new high, excess high, high of the high, excess high, short, right? Your target is the new base value, which is the low. Anything under this low in this time period, being that it hadn't exceeded yet, would be an excess low. Now you see why this dotted line matters? Because after it cracks here and holds the low, down here would be an excess low intraday. All right, not in the macro. This is a 30 minute, so you know. So as you can see, it cracks here temporarily, right? But what happens? That's what happens. You get smoked because one, there's no short positions to really even cover any of this, right? You had one here, it got smoked, and then you got a little pre-exhaustion here. Didn't really work. Tried to push it down, bounced up, excess low, cracked it. Still no short positions really to be had on the trade, right? Then you get some pre-exhaustion here again, right? So anything under this, anything above this is just shorts can't do anything to be back like green on the trade. So let's say you shorted here and you're an asshole and you didn't cover, you're red, comes up here, you try to add a little bit more shares, you get it back down. You can't get to break even, or you're trying to get to, right? And that excess low happens, it gets there for a second. Everyone that shorted here trying to cover, spikes back up. You see that volume, right? Spikes back up, boom, cracks, and then runs because now there are, again, no more shorts in there to cover or to hold this price down. Okay. So you got to crack up, and now no one's going to short this because they got smoked. Pre exhaustion again. Hey, let's try this one, guys. Pre exhaustion, boom, holds, boom. First short position happens here. Value increases, as you can see, right? So let's just say this was a trend, which I'm not going to identify as a trend right now, but I'm just going to show you. Let's say it was a trend, right? Comes down, value increases, cracks back up. What you want to see is a rejection, 2 rejections under this level in a row. This is a closeover. This is a closeover. You don't want that, right? This is where you want to likely cut the trade because this short position is going to be encapsulated again. So technically, if this was the new base value low and it increased here, right, and it rejected, you want it to hold what? A new base value. If the price increased, and as I said, it expanded the price, right? A new base value comes in. Now this here is your excess low. See? And this is your new low. All right. Now this guy is just a reference, so you're gonna make that one gray. Okay. Now, once it cracks and gets to this level here, right? Anything here or below would be excess, as you can see. You'd think, hey, you know what? Let's just keep on shorting it. Nope. There's still no short positions here. So these shorts that got the reward from here to here, right? After this last one was encapsulated, no, they have to cover because under here, right? Under here, it has to get to here, but this would be excess because this was the new base value. So being that this was the pre high, now this is the excess high. This is now the low, right? This is the median. This is the high. Okay, high of the high, excess high, which is this range here, and that's where you can get the short back to the median and to the low in reverse, right? Again, if this was the excess low here and it cracks, then now the excess low is the previous low, which makes this an excess low, and that's why you get the price increase. Does anybody have any questions? Okay,
So
good.
when you say encapsulation, James Q, I get what you mean. And
Hmm.
you say like a level is at a certain point, it was, for instance, it was a high. Uh, but going back to that, how do you quantify or how do you identify and just basically define that encapsulation? How many closes over that level do you need for it to be encapsulized?
You want to see it happen with volume and strength,
Okay.
right? So one of the like this, for example, is an encapsulation. This crack over this median was good. It held it, but this can still come down. This is still fairly weak. You got shorts from here to here. A crack down, that wouldn't be an encapsulation. But this over this level is. See that? This is
Yep.
much stronger than this was, right? And remember when I spoke about the price changing within a certain amount of time? Look at
Yep.
how this one traveled and look at how these traveled. Not the same, right? This candle had a low, a range of $1. This one had a range of 48 cents. See the difference? 48
Yep.
cents, 48 cents, 65 cents, 65 cents, 73 cents. So this traded out of the normal range. So it's kind of like an anomaly candle in this period of time after you got the fair value filled. All right. So this one was a dollar crack higher than normal. As you can see, even on this progression, this one candle here had the highest volume. See? So it cracked with strength and price. All right. So now this is actually the trend. I'm not even talking about this one because let's delete that one. I didn't like it from the beginning. This is the trend I would actually look for. Okay. Because that's where we got our price increase. That's where we got our short encapsulation. And this is where I can identify whether or not some short shares will be coming into the trade and if it will crack under that excess low. Okay. Anything before that, you're kind of tripping. And you also don't want to short this because, again, there's that fair value low here and you're only risking 40 cents, maybe a dollar. Not too sexy, right? So that's one that you'd be looking for as time goes on. You could also use what regressions. You could use regressions and it would have told you the same exact answer. See that? The regressions, rejection, 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 over rejection. This is a progression, progression over the regression, right? And it holds and continues, cracks and then falls and then back over the regression, cracks under it. So you can know, like, there are some short shares coming in here, right? As
Yep.
it's trading. So keep that in mind. Regression lines are always good if you don't know what the hell you're doing in that time or in that moment. Um, so again, let's go back and let's start identifying these real quick. You got this I'm sorry, this short position that's added here. You got some pre-exhaustion here. Not the best, but you know that it's an increase after a high, right? So you identify that one. You identify the second one. On a third rejection of the same level, which would mean that there's a full position short, you can short the trade. For instance, when it cracks here, then you know that you can get this move to here, but you know this is an excess based on what we were speaking about before, right? If you were to long here and then you saw the price increase, right, and it was a low, you'd long it again, and when it came back down, you'd long it again. You have your full long position. You're like, oh, this is a trend, and I'm full port, right? Well, I got full size on this trade, right? It works the same exact way. Everything happens in time. So like algorithms are based on the amount of time shares are being bought and or sold and how many they can get within that transaction period. Um, if you want, you could look up TWAP. That's the time weighted average price, and you could also like use that in conjunction with your VWAP, which is your volume weighted average price. I actually might ask Richard the Red to see if there's a way that he could make that into an indicator. I think that'll help you guys out a lot.
Yeah, I just wrote that down.
Okay, perfect. So you got this rejection here, and then you got this second rejection here. Obviously, you'd be looking for a third one for a short. But again, if it cracks and holds over this level, we already identified what the intraday lows would be, right? So this is why you get this really high sell here, because this is a retaliation, right? This was the first retaliation. This should have been a retaliation, but there was nothing they could do as it had fair value fields here. They should have cut the trade if you were short the moment that this held. That's just a smart thing to do. It's not worth risking, going red on the trade. But anyway, so there's buyer's retaliation and there's short coverings, right? Buyer's retaliation is when it hits an excess low and or when it hits a low too early and it needs to be filled and buyers come back in and push the price up. A short retaliation happens after a covering when it's going to their second or first short position, all right? So that would have and should have happened after a third rejection here. We should have saw an excess low and then it should have came here and then they should have tanked it. But unfortunately, they were already underwater from here. All right. Now these matter much more because now you see why this trend actually, once it tapers away from trend, you can know that the buyer's exhaustion is coming in. Okay. That's why we identify the short positions and how they're reacting. Because it's not about you know, this thing's running or this is it's doing this or whatever. You got to be able to identify the time, you got to be able to identify the action, and you got to identify when something's going to happen the fastest it can happen, because you don't want to be in a trade for fucking 6 hours. um so that's important, right? This is the most important trend that you need to worry about, because if you are long and or if you are short, you're going to want to know when the price is going down. If you're long, you're like, oh shit, when should I sell before the price goes down, right? If you're short, you're like, oh shit, when should I sell while the price is going down? So both parties actually have the same exact outlook. You want to know when you can possibly lose money. So in that event, look at your short positions and identify that. All right. So next, you get this short retaliation. It happens. Boom. Remember, we already spoke about how this increased. This was the low. If anything here and below would have been the excess low for this period, it cracks up, completely encapsulates this guy again without stop, right? But this happens because these shorts from here are covering, because any pre-exhaustion that happened here, right? Let's say you saw this guy get smoked and you're like, oh yeah, pre-exhaustion is coming in, I'm short, right? Boom. Oh, pre-exhaustion is coming in, I'm short. Boom. So you're green, right? Here's the first long position that really smoked the trade. You're gonna cover some here. The price is gonna come back up, right? Then it's gonna come back down. You're like, oh, I want a little bit more. What happens? You get smoked, and here's the short retaliation for this short, right? Because now this position is red. Short retaliation, big rejection. As you can see, throughout this entire period, this was the highest volume period. Why? Because this is a short retaliation after two short positions. This is basically 66% of a swing position. Think about it like that, all right? So the retaliation happens, the shorts get out green, right? And when they buy their shares back, the price goes up along with buyers knowing that it's near an excess low, and that's how you get the fastest move. Does that make sense? Anyone have a question about that?
Makes sense.
Okay, cool. So now that we have identified where the short coverings have been, we've identified the trend as to when they're coming in and how they will come in. We know that a crack away from trend, I've been teaching you guys this since fucking 2020, 2021, I don't know. When something cracks away from trend faster, right? That means the price is exceeding or declining. In this instance, it touched it and it rejected from the trend faster. As you can see, it increased over time. Boom, right? If it came here, boom, and then it just went boom, right? That would mean that the buyers came into the trade faster, which happened here, right? But as you can see, tap, tap, die, tap, tap, and then it's a slow turnoff. So this is one of the situations where you can say to yourself, right? You don't have to short here, but now you know that it's no longer, the price is no longer increasing as fast as it was, as this was every hour, right? So, yep, 8:30 to 9:30, and then here it should be 10:30. It should, right? But it's not. It cracks up, and at 10:30 it's running. So what happens at 12:30 or 11:30? It's still not there. The price hasn't increased there, right? It should have tapped it just as fast as any other time, like it did here. Okay, but it didn't. So now you know the buyers are tapering off with their retaliation, right? So you don't short this one, you short the excess high. Because remember, this was the excess high, because this was the high, and this is the high of the high. And you have two short positions, boom, right? This is an excess low, crack. This is a new high, right? Remember, boom, crack through, increase, level. This is here now. Crack, high, don't short that. High of the high, short that. Does that make sense?
Yep.
Okay. Now here we have the first, technically, the first actual short position, because this one never gets encapsulated until here. Until here,
Wow.
right? So everything goes back in reverse. We need to get this one, then this one, then this one, then this one. So once we get under this guy, look how close this one is. How hard do you think it is to short this price to this price? Fairly easy, right?
Yep.
Why is that? Because the longs are also exiting at this point. So this is your first short position. We need to get here, because getting here to here will be fairly easy. Longs, this is an excess high. They're cutting and shorts are entering. Price goes down. Boom. We get to this bad boy. Yay. Boom. Falls right through it. Right? So if this was the excess high, this is the high. This would be our median. This would be our low. So what does that make this?
Excess low.
Exactly. See how that works? Excess high, high, median, low, excess low. High of the high, excess high, low of the low, excess low.
So it's
Got it?
just like those levels in reverse.
Exactly. So short position 1, which is very smart. None of us really, sometimes we wait for that. Sometimes we don't. Right? Short position 1, 2, 3. That's a trifecta. I like to call it like the rule of 3. I would prefer getting this one because these two are super close, so I kind of like wouldn't count this one personally. But I would go 1, 2, 3, and once it gets below this, I know I can get a full move without like any problems really. So once I get under this level, really, which is the second, I'm like, all right, I'm straight. So boom, crack. I know it has to hold over this to continue. So you notice a lot of times we're trading live, and I'm like, hey, it has to hold over 154 to continue. For example, like here, it cracks over 154. I'm kind of shaking because I don't want it to come back up here, right? It can tap it. If it fails, all right, cool. I'll put my stop like one tap above entry. If it gets here, I'm out, right? No problem. Short, boom, cracks. I might scale here. Likely I'm going to scale here because it just makes more sense. I'm shorting it into the short position. So short, short, 1, scale, scale, out. That's how I would do it. In, scale, scale, out, and or hold 1 if you like, right? If I'm going in reverse, which would be the same thing that happens here. So this is just a trade in parallel of this. See this head right here? There's a head right here. See this low right here? There's a low right here. See this consolidation bounce right here? There's a consolidation bounce right here. See this consolidation excess low here? It's same thing happens here, right? It's just in reverse. The same way this goes down, this goes up. See this big ass green candle here? That's the big ass red candle here. The big ass green candle here? That's the big ass section right here. Just in reverse. All right. So trading in parallels is important. Trading under time is important, and understanding where the positions are is important. So when you're looking for value and you're looking to find a trade, you need to know, hey, well, where are we? Are we in the macro? Are we in the micro? Are we in the macro of the micro? Are we in the micro of the macro? All this matters because when you zoom out, let's go to the 5 now. When you zoom out, this doesn't go back as far as the last one did. How many days did you have on that chart? 30, 10 days. Okay, let's go 10 days. Add time frame, intraday, 10 day, 5 minute, and apply that. Okay, 10 day, 5 minute. Okay, perfect. Now look how easy this looks. Does that make sense, Phil? You see the reference, right? We get over this big, obviously it's not going to be yellow on your chart, or maybe it will. We get over this short position. Does this look like does this look like it found value on the 5? Would you say that it found value here?
Yeah.
Yeah.
Exactly, right? You wouldn't say that on the 30. You can clearly see intraday that it found value there. See? That's important. So now you know intraday, this is value. You're not going to short that. Okay? You're
Definitely.
only going to short it if it cracks below it, comes back up, and rejects it, because then you know it lost value, and then you can short it. Okay? So if this found value, and this is a high, this is the high of the median, you can short this temporarily, right? Anything below this, right? Because this is value, is going to be excess. Look what happened. It cracked below it for probably 0.1 seconds because this was an excess low. This is why
Right.
intraday levels matter. Unless, again, you're going to be swinging for 2-3 days. So you enter this trade, you sit, do, it cracks up. This is a markup of the median of the median range, but it's the high of the low, right? This is the low, the new low. This is your high until it's confirmed as the median. So you're going to scale some here. As you know, It's just going to make sense to do so because this is now the low, this is the high. You're going to scale some because it's the previous high. You don't know if the median is actually here, right? You don't know that yet. Action hasn't come in. You're going to scale some. Boom. You know this is an excess high, right? Now, again, you can be a smartass and wait here for 30 minutes and then come all the way back down and then wait for it to come back up and then wait for it to come back down. Or you're like, all right, boom, that's an excess high. I'm going to scale some. You see the short position happen intraday. You see that? See that big guy?
Yep.
Comes back up, rejects it twice, boom, and then what happens? Encapsulation with strength, right? Boom, with strength here, boom. So now you got the short, cracks the price back down, it gets over it again, then 1, 2, crack, encapsulation short, 3. So let's delete this and let's show how it looks intraday. And let's zoom into that. This guy, friend number 1. This guy, friend number 2. There should be a third. Second gets encapsulated, crack, boom, retaliation. That's all one linear line. They have the full position short, inverted hammer on low volume, crack. This is a short or a scalp short. You can only short it to, again, the previous high, which is now the median range because that's the high, you know? So you can only short to here. Okay.
I know. So you said something interesting on there. Go back a little bit on the chart. This pop, go over a little bit more to the other, closer to current day. Sorry.
Here.
So that little pop you said a second ago, you were like, it's going from the value area, and we're going to find a high.
Mhm.
But this little consolidation period in the value area never found a median until there was a technically another high reaction that made it an excessive high.
Exactly. So remember, this was your target because this
Yep.
is your short position, right? This was your low. All right. So let's just look at that. Remember, I said I didn't draw it because you don't have to. You can see it with your eyes. Now the fair value fill is here. This is the median range of the short.
Right.
So those shares need to be filled. If you're a short and it doesn't reject this, it's gonna hold and go back to that short position.
Yep.
Right. So let's just before this holds, let's start all over. If this is the low and that's the median, that's the high. Okay.
Yeah. Right.
So now if this cracks and this holds, this is the low, right?
Yep.
This cracks and this holds, as you can see, it does here. This is the low, this is the median, still the high, right? Cracks up, boom, increase. This gets encapsulated, and now it's holding. If it came down rejected, boom, 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 that'd be a different story. But now this area that was your high for the low is now a low as the price increased. Because otherwise it would have tanked, which it should have, but it didn't.
Mhm.
Right?
Right.
So yeah. So this is now, and this was after hours as well. So it's a little faulty there. But generally, what you're going to see is you're going to want to see some type of consolidation or capitulation. And in this scenario, this is actually a consolidation because it's finding value as the price increases, right?
Mhm.
A
Yeah.
capitulation is something holding an area and like slightly losing value as time goes on until the price gives up, whether it's up or down, right? So let's say you see the price trying to find, it comes down to here, right? For example, and it's like do 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 boop 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 boop, and it's supposed to be a bear flag, right?
Right.
It's supposed to be, but the lows are increasing, right? The lows are increasing, increasing, and the highs are staying stagnant, right?
Right.
It's supposed to be a bear flag and go boop, but a capitulation would be like boop, higher, 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 higher within a range, and then the shorts will give up and it'll run, and vice versa, right? So a bear flag would be it comes down to here, do 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 do, bang, right? The capitulation would be comes down to here, boom, and then slowly one side starts to give up, and then it runs against what it was supposed to do. And it would be the same thing for a long. A capitulation would be coming up here and then down, and then as you can see, these highs are getting lower. See that?
Yep.
Right? As that happens, it's supposed to give. It tried, boom, came back up and held and showed you that it wanted to leave that as that value area. Then it got higher. Then it got higher. Then it got higher. See?
Yep.
Shorts try to come back in, try to push it down. Boom. This is our golden. I remember when everyone used to look at these. Be like,
Oh,
oh my God, bullish engulfing. Remember when that mattered? Um, but yeah, so this is not a capitulation. This is a consolidation because the low accepted as too low, right? And the high was high, as you can see, but the median increased. See? If you draw a straight line like this, you're going to see it go boop, 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 hold, crack, close, higher, crack, hold, and then tries, boom, and then gets smoked, right? That's why this is a consolidation. If you wanted, you could make this box even smaller and look at it like this. Hold on. What's wrong with your computer, bro?
Essentially, then, if it was encapsulation the other way, that red candle right next to that green candle would be high volume and coming with strength.
Exactly. The issue is on this, there was really no shorts on it, like when the
Right.
price increased, right? So you had an increase of value to the long side, and it happened every 10 minutes. You can't see that, but I can, right? So like, look here, 5, 5, 10, 5, 5, 10, 5, 5. See that? Happened every 10 minutes. And then once it finally cracked, right? Then it came down, but the value never really gave. See that? So these are things that you kind of need to identify. You might be able to see it on the one. Let me see. As a matter of fact, he doesn't have a 1 day 10 1 minute 10 days. So let's not even waste our time. But yeah, hopefully that answered your question.
Yep, it did.
So where was I? I'm sorry. So yeah, that's what happened here. Let's delete this. So as this increases, boom, short position 1, short position 2, they finally got the third, pushed it down, came back, right?
Yep.
Came back, shorted again, boom, full position here. So this is a clear short, right? This is a crack, but all these short shares are still here. Fail 1, fail 2, that's all you need. Boom, rejection. Remember when I said you want to see it come back up and then
Yes, sir.
reject it and short it? That's where you short it. Boom. And then obviously you see a
All
price
these
increase.
areas, that's the value area now, right? Anything where below that area, up until what would this be now at this point? That would be excess low right there
This right here, let me see.
at the
Low.
152 level, around 151.91. That would be the excess low. So
It
would that
wouldn't.
be the excess low?
No, it wouldn't. I'm gonna show you why. Because remember, this was value. This was our temp high.
Okay,
This was the low. Because it cracked it, this was the median. This was the high. This is
I
an
got
excess high.
I got
All
you.
right. Like, but because it's so close, you would just be like, oh, it's a high of a short position that's already there.
Okay.
Right. So that would be high. This would be the median range. And if it holds this median range, it's still long. Nothing changes. Right? Nothing changes on the trade. So if it holds the median range in the macro, it's still long. So if you try to short this, good luck. If it cracks to the low, right, again, crack, rejection, you can short to the low. But if you try to short that excess low, good luck, right? Now, if it cracks under this, comes up, rejects, no matter what happens here, because that excess low gave out, it needs to find a new base value low, which would be here, and then obviously down the other way. So let's continue. Excess high, remember this is the high. Excess high, that's a short. This is also a short retaliation. 1, 2, 3, boom, short, boom, smoke show, retaliation, down. Because this now, Phil, is an excess high, that would be the low, and that's why it bounced.
I
Because
got you.
now you got a price increase, right?
So in that scenario, anything below 151.91 is an excess low.
Yes.
Okay,
And
I
as you
got
can see, it tried to touch it, but it failed, right?
not even giving any excess,
Yeah, immediately.
right?
And that's how you find it. That's how you find your levels intraday. And obviously it plays out the same exact opposite way. You see it comes back to the gray level that we have here. Because remember, we spoke, now you know why this is the excess low. This is where you want to take a swing trade. This is where I took the trade in my girl's dad's account and then paper handed it into close because I was like, shit, let me just get him his money and get out of here. But as you can see, not the greatest idea. Anyway, so it cracks up close to close, and I'm like, all right, take his money, let him get his money, whatever. So this is where you would take a long and swing for the next few days because you know where your targets are. Boom, you get here, you can scale. Boom, it holds, right? Because remember, excess low, low, right? But this excess low, this is a high of the low because remember now you need to find range again, but technically you already have all this information. But I'm saying it as if this wasn't here. If
Mhm.
this was an excess low, this would be your high, right? So obviously it shorts, comes back, boom, it holds. Now this is your high, so this is your median. This is your excess high, short, same exact fucking story, right? Same exact thing, just in the micro of the macro. Same story. Long, boom, comes down, fine, you're already scaled, held, up, new high, scale, down, median, high, excess high, short, right? Scale, down, up, right? Same thing. So excess high, boom, now median, high, excess high. Whoa, right? Why does that happen? Let's go back and see. Who could have guessed it? The last short position was there. Ding, ding, ding. So now you get a really huge reaction because there's no more short positions on the trade. See that? Boom.
Yep.
Boom. All right.
Yep. I see that.
Excess high, short retaliation. One. Let's zoom in. One. Back to the exact same level. Retest, retest. Boom. That's two. Tries. Gaps down. Comes back. This is tres. Boom. Lower than the low. See? Once. Should be twice. Third time is here. Same exact thing. Down. Okay, this is the high now. The median, this is the low. Anything below the low would be an excess low. Low, I can long a low, right? I can long this excess low. Intraday on the 5, right? Boom, back to the median. I'm scaling some. Boom, my goal is the high, right? I'm going to scale some here. It comes back down. It holds. Doesn't come all the way back down to the median. That's great. Price increase. New high, comes back down, fails, comes back down, right? And then runs. So what happens? Ding, ding, ding. So we got this guy here, and then they go into a sausage party. Okay. So these shorts
God.
get fucked. See? Same story. Now you guys' homework is finding value on bigger time frames, right? Because I just showed you how to do it on the smaller time frame. What you want to do is go on the 4-hour, right? And then do the same thing. So you can, and look, oh, that's cute, right? This is kind of like a regression line now that you have on your own that you drew because you were smart, right? This one's kind of fucked, actually. Yours is actually better, and the one that you drew is better. So you can see, oh, below it, oh, maybe I can short this intraday. Yes, you can. I can short this intraday. Now look at how it's reacting to this. See? All because you identified the short positions correctly. Even after earnings that it beat, it still respected it because you knew exactly where the shorts were trading in a lineage, right? So I wish I had these dates. Let's see what the dates are. Yeah. So the 19th, the 22nd. Wait, what? This was the 14th, and then where are the circles? Oh, they're mad small. I can't see them. All right. The 18th. Is there a circle here? Peanut, can you see this? I don't got my glasses on.
Yes,
Okay.
on
So
both
the
those
8th.
candles. Yeah.
Okay, cool. So as this time goes on, it looks like 3 to 4 days or something like that. They short it. 1, 2, 3, short. 1, 2, 3, short. Yeah, 1, 2, 3, same thing. So this should be coming down here. If you look at it on the 4-hour, it should be the same thing. Yep. So Monday, Tuesday, Wednesday runs, Thursday down. Yeah, so 3 to 4 days on average. Those are things that you kind of just need to know. I mean, you don't have to. It doesn't matter if you don't. Again, you don't have to make it that complicated at all. but finding value is going to be important because this is what you guys want to do long term, right? So get in that, finding the habit of doing that. We just did this on Apple. You should be able to do it on ES. Peanut, you can take over now. Whatever you got to do, bud. Does anybody have any questions?
You should
Good stuff, James.
Yes, sir. That was great.
All
I
right.
know I'll have questions for sure. I'm gonna try to get some charts in and see if I found the right value areas, and I think that'll be a good, as you said, for homework.
Yeah, for sure. Just don't send them to me.
I won't.
Okay, yeah, don't send it to me because one, I get a lot. I still get messages till this day. Don't know why because I'm like inactive on all social media, but I like when I get a lot of messages, I kind of get like overwhelmed.